So next, we want to set up our terminal value methodology. We're going to be selecting between the exit multiple, the perpetual growth, and the average. So in this case, we will go to the DCF assumptions here, where we can go Alt A VV, data validation, to bring up that menu, and then we can select, we want to allow a list, and then we can select between the methodology is going to be the exit, the perpetual growth, or the average. So we have that set up there. So we can toggle between those different methodologies. So if we want the average, we can include the average. If we want the exit multiple, we could just include the exit multiple. So having that set up, now the next thing we want to do here is we now want to clearly make an assumption for the terminal value EBITDA multiple. So in this case, if the stockholder or the shareholder will want to sell the shares at the end of the projected period or at the end of the terminal year. So if the stockholder want to sell the shares, they might want to sell the shares 25 times EBITDA. So that's exactly we are just putting this as an assumption for the terminal EBITDA multiple. So like we said, this could be determined using comparable company analysis. And then for the long-term growth, we will set this to be 4%. That is just an assumption. So for the long-term growth, we could use the equity formula. So we could use the cost of equity formula in determining the long-term growth. So we all know that the cost of equity formula will take into account the dividends of the next period divided by the price of the shares. So the current price of the stock, and then we add to that the growth rate of the stocks, which we believe is going to grow. So in that case, after knowing the cost of equity and knowing the next year of dividends and the price of the stock, we can easily reverse engineer the formula to now determine whatever the growth rate of these cash flows will be. So that is exactly what we are doing here. So we are just bringing this as an assumption, but if we want to look at that on paper, that is how it's being calculated. And then for the WACC, like we said, we have a rigorous WACC analysis that we have to construct here. So here we have our WACC sheet where we will be using several key metrics to determine our WACC. So for the WACC, we have here the total debt, which we're going to bring in from our comparable companies tab. We have here the market value of equity, and then we later on use these metrics to determine the total debt to equity and the total debt to the total capital. And then we have the tax rate, 5-year average tax rate for each company. So for some companies that are not based in the United States, such as SAP, Spotify, and Alibaba, we will have to extract their tax rate based on the countries where these companies have their head offices operating at. So that's what we're going to be doing. And then for the level better, since these companies are public companies, we can easily extract the 5-year levered beta. However, even if they are not publicly traded, we could also have this levered beta, and it's gonna be very easy for us to compute, having the levered beta to compute it on levered beta. So we are just reverse engineering the levered beta formula here. So that's how we're gonna be able to calculate the unlevered beta based on the levered beta and the average tax rate. So the unlevered beta, it is essentially the market risk that doesn't take into account debt financing. So it removes the effect of debt financing in the market risk. So the levered beta is the beta that takes into account debt financing in the market risk. So essentially what we are saying here is that we will determine the unlevered beta, and then we will re-lever the beta to now determine the beta for Amazon based on comparable company analysis. So the average of, or the median of, all of this unlevered beta would then be used to determine whatever the levered equity beta will be for Amazon. So that's exactly what we're gonna be doing here. So this levered beta and unlevered beta is a very, very important matrix in determining the cost of equity of a firm, because in this case, we're going to be using the capital asset pricing model as our estimate of the cost of equity. So the capital pricing asset pricing model